Imagine you lend your friend some money for 10 years on certain interest rate. Now imagine halfway through, your friend is borrowing from 12 other people simultaneously. He's spending more than what he earns. Every credit rating agency on the planet has downgraded him, and he keeps saying, "Don't worry, I'm good for it." Would you keep lending, or would you start demanding more interest? It is exactly the conversation the global bond market is having with the United States right now. And the answer it's giving should make everyone pay very much attention. Before you think this is some Wall Street story with nothing to do with you, please stay with me, because this touches your EMI, your mutual funds return, your grocery bill, and whether India's growth story stays on track or hits a serious wall. On May 19th, the 30-year US Treasury bond yield hit 5.20%.
US bond markets are flashing fresh warning signs as long-term Treasury yields climb to their highest level since the global financial crisis. While rising oil prices and sticky inflation have added pressures on market, analysts at Bank of America say growing concerns over America's worsening fiscal health are now becoming a major trigger behind the sell-off.
The highest level since July 2007, right on the eve of the global financial crisis. The 10-year yield, which sets the benchmark for mortgages and loans worldwide, touched 4.68% the same very day. Now, these are not routine market moves. This is the bond market sending a signal. And the question is, danger or opportunity? Let's find out. Now, to understand this, you need to meet one character, that is the US Treasury bond. For over a century, it was the safest investment on earth. You lend money to the US government and then they pay it back always. Every central bank, every pension fund, every sovereign wealth fund in the world held them. India's RBI holds them, so does China, so does Japan. But after 2008 financial crisis, something changed. The US Federal Reserve kept interest rates near zero for years and bought trillions of dollars worth of bonds itself. A policy which they called as quantitative easing. Cheap money flooded the world. Stocks boomed. Real estate boomed. It felt like free money forever. And then came COVID. The US printed and spent at the scale never seen in the peacetime. Trillions in stimulus. Trillions more in rescue packages. By mid-2025, the US federal debt had surpassed $36 trillion, which is 124% of its GDP. Interest payments alone crossed $1 trillion annually, more than the entire US military budget. And then on May 2025, the last wall came down. Moody's downgraded the US credit rating from its perfect AAA to AA1, becoming the third major agency to do so, after S&P did it in 2011 and Fitch did in 2023. For the first time since World War I, not a single major rating agency gave America a perfect credit score. The bond market actually was listening. And here is where it becomes genuinely very surprising. Most people assume bond yields rise because investors think that the US might default. That's not the real story. The real story is about something called the term premium. The extra compensation investors demand for locking up money for 30 years when the future feels uncertain. For most of the 2010s, the Fed's bond buying program surpassed this premium to near zero. The Fed was essentially the giant insurance company underwriting all that risk, and that's over. The Fed has been selling bonds back. Earlier it was buying, now it is selling bonds back, and the real investors are now demanding to be paid properly. And here is surprise one. Annual US deficits are running at roughly $2 trillion a year. Dealer surveys project the deficit at $1.94 trillion for financial year 2026, rising to $2.05 trillion in financial year 2027. And to finance this, the Treasury floods the market with bonds. Now, when supply overwhelms demand, you all know that price falls. And when price falls, yields, they go up for the bonds. Basic economics playing out in real time. And then there's surprise too. The traditional local buyers of the US Treasuries, China and Japan's central banks, have quietly been stepping back. And in their place, hedge funds and impatient return-driven investors have moved in. These buyers will sell the moment they see a better opportunity, and that makes the market more volatile than it has been in decades. And then comes the geopolitical layer. The war with Iran has driven oil and gas price to 4-year high, and the Strait of Hormuz effectively disrupted. US consumer inflation ran at 3.8% year-on-year through April 2026. Wholesale inflation hit 6%. Against this backdrop, a Bank of America survey showed 62% of the global fund managers now expect the 30-year yield to reach 6%. A level not seen since the late 1990s. Barclays and Citi have warned clients yield could breach 5.5%. They have warned their clients that the yields yields could breach 5.5%, and BlackRock, the world's largest asset manager, is now recommending investors reduce their exposure to the US Treasury bonds. Just imagine. That last sentence actually deserves a pause. When BlackRock tells you to hold fewer US bonds, the world has genuinely changed. On the surface, India looks insulated. A relatively close capital account, fastest growing large economy in the world. A good story, but look closer and the pressure is real. The US 10-year bond sits at 4.6%. So 10-year bond yield is 4.6%. India's 10-year government bond yield is at 7.1%. A spread of roughly 250 basis points. On paper, Indian bonds look attractive, but here's the catch of the rupees. If the rupee keeps weakening, that extra yield evaporates for a foreign investor. The rupee is sliding towards a 97 per dollar now, and the RBI's net short dollar position in the forward market has hit $103 billion, meaning that the central bank has already committed enormous resources just defending the currency. And India's benchmark 10-year yield has already crossed 7%, and analysts at the Bank of America estimate the current account deficit could widen to more than 2% of the GDP in the financial year 2027. The widest since the taper tantrum which was done in 2013, when the rupee crashed from 53 to 68 rupees, a humongous crash. And that episode was triggered by the Fed merely hinting that it would reduce bond purchases. But by merely just hinting that they would reduce bond purchases, taper tantrum happened. And what's happening today is more structural, and India needs to be alerted. Here is the one thing which I want you to remember. For 15 years, the world ran on what economists quietly called as a free money era. The US borrowed at nearly zero cost. Governments spent freely, asset prices inflated globally, and the entire financial architecture rested on one assumption, that the US Treasury yields would stay low forever. That assumption is cracking now. The US Treasury bond was the world's bedrock for 108 years. Every crisis sent investors toward it. Now, all the three rating agencies have cut it. Its biggest buyers are retreating, and the 5% bond yield level, which was long considered a floor where buyers would rush in, has been broken through. This is not 2008. In 2008, the danger was hidden inside the financial system. Today, it is visible, structural, and not fixable with a weekend rescue package. You cannot resolve a $36 trillion debt program with a press conference. The free money era is over. The era of earning your credibility has begun. Countries that built real foundations, fiscal discipline, manufacturing, or energy resilience are the ones that can come through and that will come through. And countries that borrowed their way to growth will feel this is the most. See, when the safest asset in the world is being repriced, when the bedrock of the global finance starts to shift, you have to ask yourself one uncomfortable question. If the foundation was never as solid as we believed, what exactly have we been building on? Tell me what you know in the comment section and what you think of it in the comment section. I'll be very happy to read your comments. All the very best. Have a beautiful day. Thank you.